In my last video, I gave an overview of the Help to Buy scheme designed to help first-time buyers climb the property ladder. Amongst one of the options, there was the equity loan, which basically means the government lends you money at zero interest for 5 years, and in return they take a stake in your property. So they lend you 40%, they own 40% of the property. But there's something more sinister when I started looking into the Help to Buy scheme, particularly the equity loan. I initially thought it's a good opportunity for first-time buyers to get a property. If you borrow less money in a mortgage compared to the property value, this means that the loan-to-value ratio, or LTV, is lower. And lower LTVs usually mean lower interest rates, as their risks are also lower. So with that in mind, some of you might be thinking, I'll just take the maximum government loan, take a mortgage on the rest and pay as little as I need over 25 years. I'm starting to sound a bit like Graham Stephan there. But in this case, I'd say hold on a minute. Have you worked out how much interest you'll be paying by the time you reach year 25? Unlike those ridiculously good 30-year fixed-rate mortgage you can get in the US, with your equity loan, your interest rate keeps rising over time to account for inflation plus 2%. As the table shows on an example where CPI, that is inflation, is 2%, your interest rate from year 1 to 5 is 0, but in year 6 is 1.75 and in year 8 it rises to 1.91. Right, from 1.75 to 1.91, that doesn't sound like much of a hike, but how about in year 25? Fear not, because I've crunched the numbers and it turns out in year 25 your interest rate on your equity loan will be, drumroll, 4.08%. So it's slowly but surely crept up. And here's the fine print you need to watch out for. Stay with me, this is important. The amount you owe isn't the amount you borrowed. What you actually borrowed is the value of the property. So say the equity loan was 40%, which works out around £240,000 for a £600,000 property in London, let's say. Your debt is not the £240,000, but 40% of whatever the value of the property is. So if the property price goes up, so does the amount you owe. And remember, your interest rate is also rising, as I explained earlier. But the other way is true as well. That is, if the property price falls, the amount you owe falls as well. Again, I've crunched the numbers and from my calculation, it turns out, under reasonable assumption that is, it's cheaper to get a mortgage. Let me explain with a good old-fashioned spreadsheet. So, with the equity loan, for the first 5 years, you don't pay anything, but from year 6 onwards, you need to repay at least the interest part of the loan. Now, that starts off at 1.75%, but will adjust according to inflation, which means it goes up again, as I mentioned earlier. That's one thing you need to be careful of. The other aspect is the house value itself. Going back to our previous example of the £600,000 house with a £240,000 equity loan, if you assume a 5% property growth rate, at the end of 25 years, the property would be worth over £2 million. Now, if you sell your property then, you will have to give back 40% of the property value, which is £812,000. That's not bad for a £240,000 loan, isn't it? But here's the killer. Remember that 1.75% interest rate that slowly rises over time? Well, it's not 1.75% of the original loan, which in this case was £240,000. It's 1.75% of the house value at the time. So by the time your property value doubles, the amount you owe to the government also doubles, and the interest you have to pay also consequently doubles. I hope you realize how bad that sounds. Imagine you have a credit card and you actually got told that the debt amount has now increased as well as the interest you have to pay because the markets went up. Doesn't that sound outrageous? If that came from a private business, which is obviously seeking to maximize profits, you might understand and perhaps not be surprised. But this comes from the government, whose purpose is to improve the welfare of the people. It also means that for those looking to buy a property for the first time and also as an investment, then they really should not use the equity loan, because remember, the more it appreciates, the more money you owe and the more interest you pay. But I mean, most people would want to buy a property that also appreciates over time, isn't it? And for those who can't get a decent mortgage because of low deposits and not meeting the eligibility criteria, then the equity loan is an option. But don't be fooled in thinking you're getting a better deal, because as I have shown, this may not necessarily be the case. And that's what saddens me a bit, is that those who need it the most may get squeezed the most. It's a bit like payday loans, isn't it? And if you do get a mortgage longer than 25 years, your equity loan scheme will be extended, because after all, the longer this goes, the higher the interest rate and loan amount. Unless I'm missing something here, this doesn't look great. Let me know in the comments below what you think, and if there's anything you don't agree with, I'd love to discuss. And if you haven't already, remember to like and subscribe. Until next time.